Welcome back, Crypto Monks. In this section, you'll learn about moving averages as technical trends. Pretty much everyone is familiar with calculating an average value for a data set by simply adding up all the values and then dividing by the number of samples used. Moving averages do something similar for the average price over time, and that makes them an excellent way to get an idea of the general direction of the market. The exact calculation of a moving average will vary depending on the type, but the goal is always to provide value by visualizing important market features such as trend direction, strength, and trend changes. Other features that affect the direction and angle of the price movement might also be reflected in the trends. If you're trying to keep it basic, you don't have to stress about whether you're looking at the right kind of moving average, and you can just stick with the simple moving average. They tend to be the best type of moving average to help find support and resistance levels on a price chart. All your charting tool is doing is adding up the price for whatever the number of periods you're looking at, for example, over the last 200 days, and then calculating the average price over that time. In that example, you get a new 200-day simple moving average data point at the end of each trading day. And what you end up with is a trend line built from the daily updated averages. These trend lines are much smoother than tracking the price action directly, and it is this smoothing that helps to remove some of the noise in the market price action to give a visual cue about whether the market has been bearish or bullish. SMAs, or simple moving averages, are the slowest and least responsive moving average that we'll look at because they give the same weight to every data point in the set. This means yesterday's price weighs as heavily on the calculation as the oldest price in the time period. Clearly, more recent prices should better reflect the current state of the market, and it is probably suitable for them to be given greater importance than very old data points. This is where weighted moving averages come into play. Weighted moving averages are harder to calculate by hand, but since the computer does all the heavy lifting, they're just as easy to use, but also provide the additional benefit of being faster than SMAs. We call them WMAs, and they treat older data points with less importance during calculation so that yesterday's price point is more important than the price last week, and the last week's price is more important than last month's price. It makes sense, and it results in a moving average that is more responsive to recent price action and more forgiving of older price action. Critically, that feature makes it better than SMAs for identifying trend changes in volatile markets like crypto. If you're worried about entering or exiting a position due to a sudden trend change, then a faster moving average may be the best option. There are faster, potentially better, and more forgiving moving averages than linear weighted moving averages. Exponential moving averages really do everything that WMAs do. After all, they're a form of weighted moving average. But rather than letting the importance of old prices fall off linearly, EMAs drop off at an exponential rate. Older data points become less important faster, and newer prices have a higher weighting, all resulting in increasing the speed and responsiveness of the indicator. More responsive indicators are beneficial if you're concerned about a sudden change in the momentum or direction of a trend in the volatile market. In those cases, an EMA might give you an edge to react just a little bit faster than the trader using a standard WMA. If you're really looking for faster moving averages, then keep in mind, it's not just the type you pick, but also the time frame. By definition, a 50-day moving average is much faster than a 200-day moving average. So by selecting the right time frame, that's very important in selecting the right kind of moving average. Envelope channels are a technical indicator that defines trends, measures volatility, and indicates whether prices are high or low on a relative basis. Bollinger Bands are a specific type of envelope channel that are typically plotted to standard deviations above a 20 simple period moving average. That means 95% of the historical prices will be contained within the bands. The slope of the bands can be used to identify potential trends. And if the bands are sloping up, you may be in a potential uptrend. And if the bands are sloping down, then you're in a potential downtrend. The bands expand and contract to identify volatility. When the bands come together, restricting the moving average is referred to as a squeeze. That indicates low price volatility. Conversely, the wider the bands move, the more volatile the pricing. When the pricing touches the upper band, it generally indicates that the price is overbought. And when the price touches the lower band, it indicates a buy signal because the price might be oversold. When the price goes outside of the upper or lower band, it's referred to as a breakout. A successful trader benefits from the ability to identify and effectively respond to traditional trends faster or more efficiently than the other guys. Moving averages are a powerful category of tools that will help you do exactly that. They smooth out and weight historic price fluctuations. They identify support and resistance trends, and they can even give visibility into market volatility. Including one or more of these averages in your trading toolkit is an important foundational step for any trader. CryptoMonk's content is not financial, tax, or other advice. Never transact based on it. Do your own research and consult certified advisors. Investing is risky and you could lose everything.